December 2025. While you're reading this, they're wrong. Not because they're lying, not because they're hiding anything, but because they're ignoring the math. While you're being told everything is fine, 14 specific indicators are already flashing red. The same indicators that flashed before the crash of 1929. The same ones that appeared before the dot-com collapse in 2000. The same warnings that were dismissed before 2008. Right now, those signals are aligned again. This isn't a theory, it isn't fear, and it isn't hindsight. The mechanisms are already in motion. The timeline is no longer abstract. There is nothing left that can stop what has already been set in motion. There is only the ability to delay it. And that delay creates a final window, roughly 18 months, before the unwind accelerates. 18 months to reduce exposure. 18 months to move capital out of vulnerable positions. 18 months before the largest wealth transfer since 2008 begins separating the prepared from the unprepared. This is not speculation, it is mathematical inevitability. And once you understand the pattern, the only question left isn't whether a crash will come, it's whether you'll recognize it in time. Crashes aren't caused by age alone. They're caused by conditions. Specific measurable conditions that build over time and create structural instability. Markets don't collapse randomly, and they don't collapse because a cycle gets too old. They collapse when these conditions align. And when they do, the sequence is always the same. Every major financial crash in modern history follows a four-stage pattern, without exception. Stage 1 is excessive optimism paired with rising asset prices. Confidence expands, valuations stretch, and risk is rewarded. Credit becomes easier, leverage increases. The system appears strong. Stage 2 is when warning indicators begin flashing quietly at first, while being systematically ignored. Data deteriorates beneath the surface, but prices remain elevated. Experts dismiss the signals. The consensus insists nothing is wrong. Stage 3 is the trigger. It's often unpredictable in form, but irrelevant in importance. The trigger doesn't cause the collapse. It exposes the fragility already built into the system. Stage 4 is cascading failure. Forced selling begins. Margin calls accelerate losses. Liquidity disappears. What looks stable collapses rapidly. Right now, the market is firmly in stage 2. The indicators are flashing. The data is clear. And just like every cycle before it, they're being ignored. History proves this pattern without exception. And once you understand it, the past stops feeling distant, because you can see exactly where the present sits. In 1929, the Roaring Twenties were in full swing. Prosperity seemed endless. Technological breakthroughs, mass production, and consumer confidence fueled a stock market that rose nearly 400% in under a decade. From Main Street to Wall Street, the belief was universal. The good times would never end. Beneath this optimism, however, a different story was unfolding. Margin buying expanded aggressively, allowing investors to borrow heavily against rising prices. Debt accumulated quietly, and structural weaknesses began to form across the financial system. Agricultural prices had been collapsing since 1926, yet few paid attention. Consumer debt reached record levels. Florida's commercial real estate crash in 1926 was brushed aside. Banks increasingly turned lending speculative, ignoring the early warning signs. By 1928, the yield curve had inverted, a classic red flag, and yet experts reassured the public. Irving Fisher declared in September 1929 that stock prices had reached a permanently high plateau. Then came the trigger. Black Thursday, October 24, 1929, followed by Black Tuesday, October 29. Panic spread. Forced selling cascaded through the system. By July 1932, the market had fallen 89%, roughly 9,000 banks failed. Unemployment reached 25%. Warnings had been ignored because people believed this time was different. The lesson was clear. Optimism can silence even the most obvious red flags, setting the stage for the collapse that inevitably follows. In 2000, an entire generation was told the old rules no longer applied. The internet had transformed business, and with it, investor psychology. Technology promised a new era where profits didn't matter, valuations were irrelevant, and traditional metrics were obsolete. The Nasdaq rose nearly 400% from 1995 to 2000, fueled by speculation, easy credit, and investor euphoria. Companies were valued in the billions without posting a single profit. Margin debt climbed to 2.7% of GDP, enabling even more leverage in an already overheated market. Corporate debt swelled as firms borrowed to fund expansion and buybacks. Technology stocks routinely traded at 100 times earnings or more. Warning signs were present. The yield curve inverted in 2000. Rates had risen from 4.75% to 6.5%. Yet experts reassured the public. Consensus insisted that this time is different. The peak came on March 10, 2000. When the Nasdaq reached 5,048, over the next 2.5 years the index fell 78%, erasing $5 trillion in market value. Retirement accounts, pensions, and countless companies were wiped out. Once again, the same pattern repeated. Optimism blinded the public to measurable risk, warnings were dismissed, and leverage amplified the collapse. History proved that belief in a new era always precedes financial disaster. By 2008, leverage had moved from the market into the financial system itself. Housing was no longer just an asset, it was the assumed path to wealth. Prices had doubled from 2000 to 2006. Subprime mortgages were issued with little or no down payment, often without verification of income or assets. Banks originated these loans, then bundled and sold them into complex securities, distributing risk across the system. Housing starts peaked in 2006. Defaults began rising in early 2007. Yield curve inverted that same year, signaling a slowdown, yet experts reassured the public. Ben Bernanke insisted the subprime issues were contained. Hank Paulson claimed the system was sound. Consensus prevailed. Fragility grew quietly. The trigger came with Lehman Brothers' collapse on September 15, 2008. Suddenly, the hidden leverage was exposed. Credit markets froze. Forced selling cascaded through banks, corporations, and households. The S&P 500 fell 57% from peak to trough. $11 trillion in household wealth vanished. Nearly 9 million jobs were lost. 3 crashes across 3 eras had followed the same pattern. Optimism blinds. Warnings are dismissed. Leverage amplifies and collapse unfolds. 2008 was no different. The past was no longer distant, it was instructive. And the stage was set for the present, where history would repeat once more. Now look at today. December 2025. The story of past crashes is no longer history, it's a mirror. The total U.S. stock market is valued at roughly $60 trillion. GDP sits at $26 trillion. The Buffett Indicator reads 230% more than double the historical average of 100%. For context, previous peaks were 148% in 2000 and 2007. The Shiller-Cape ratio tells the same story. 39 today, compared with a long-term average of 17. Past extremes hit 44 in 1999 and 27 in 2007. Every single valuation metric that has historically preceded collapse is flashing higher than ever. Margin debt, the accelerator of market crashes, stands near $800 billion, roughly 3% of GDP. Only 3 prior periods in modern history reached similar extremes: 1929, 2000, and 2007. When prices falter, margin calls for selling, turning declines into cascades. This isn't a matter of opinion, it's comparison. The same tools used to identify past crashes now point to a level never before seen. Valuations alone don't trigger collapse, fragility does. And fragility is everywhere: corporate debt, banks, and consumers all straining under the weight of historically extreme prices. The system is poised. All that remains is the trigger. Valuations don't collapse markets. Fragility does. And right now, fragility is everywhere. Corporate debt sits near $14 trillion, about 50% of GDP, well above the historical average of 35%. Debt issued in 2020 to 2021 at 2 to 3% interest is now refinancing at 5 to 6%. Interest expense doubles or triples, cutting sharply into earnings and leaving little margin for error. Commercial real estate compounds the stress. Values are down 40 to 60% from 2021. Office vacancy rates hover between 20 to 30%. And roughly $1.5 trillion in CRE loans will mature by 2027. Mismatch between loan balances and asset values guarantees pressure. Regional banks hold around $1.3 trillion in CRE exposure. The failures of 2023 SVB, Signature, First Republic were a warning, not a solution. Consumers are the final link. Total household debt exceeds $18 trillion, with credit card balances over $1.2 trillion at roughly 22% interest. Savings rates have fallen from 16% to around 4%. Delinquencies are rising across nearly every category. Fragility has been stacked from corporations to banks to households. Every segment of the system is under pressure. Prices could fall tomorrow, next quarter, or next year, but when they do, the dominoes are already aligned. Once fragility exists, only a trigger is required. And the timing of that trigger is the only remaining uncertainty. Once fragility is in place, timing becomes predictable. The sequence isn't random. It unfolds in phases, each building on the last. Through Q1 2026, markets remain elevated. Optimism persists, even as corporate earnings begin to disappoint. Defaults rise quietly in commercial real estate and corporate debt, signaling that stress is spreading through the system. By Q2 2026, a trigger event occurs. Its form is irrelevant. The system is already primed. Stocks fall 15 to 20%, credit markets tighten, and forced selling begins. Hedge funds are hit first, cascading losses into broader markets. Retail investors panic. By Q3, the decline accelerates. Another 20 to 25% is wiped out, pushing the total drawdown to 35 to 45%. Unemployment rises towards 7% as companies adjust to collapsing demand. Consumer spending contracts, amplifying the downturn. The bottom arrives in Q4 2026. The S&P 500 lands between 2,700 and 3,500, representing a total decline of 50 to 60%. The Fed cuts rates to zero and restarts quantitative easing, but the policy response comes only after the damage is done. By early 2027, recovery begins, but the losses for the unprepared are permanent. The system has proven once again that fragility, not timing or opinion, dictates the path of collapse. And the arithmetic behind it is unavoidable. This is not a guess. This is mathematics. The collapse isn't opinion, speculation, or a forecast. It is the arithmetic consequence of extreme valuations and structural debt. Mean reversion is a historical constant. It is not a hope, a prediction, or a belief. It is a pattern the numbers enforce. The Buffett Indicator tells the same story. At 230% of GDP, compared with a historical average of 100%, valuations imply a market cap decline near 57%. Debt servicing costs and refinancing pressures remove hundreds of billions from corporate earnings. Commercial real estate loans maturing by 2027 around $1.5 trillion carry expected losses exceeding $600 billion. These losses either wipe out banks or require bailouts. The timing is unavoidable. The collapse begins within 12 to 18 months. By late 2026, the bottom is reached. Recovery starts in early 2027. Damage for the unprepared is permanent. The distinction isn't intelligence, it's preparation. History, mathematics, and patterns are consistent. 18 months is the window. The system is moving. And the only remaining question is whether you recognize it before it's too late.